Now, there are two ways for you to use debt as a business owner to earn money and not pay any money in taxes legally. But I got to give you a little bit of a disclaimer here, because anytime you use debt, you increase the risk. You increase the risk of you failing. You increase the amount of expenses that you have, because no matter what happens, even if your business starts to struggle, you still got to make your debt payments. So anytime you increase the debt, you increase the risk and you increase the chance of failure. So don't do this for the purpose of just saving money in taxes, unless you really understand the risk, unless you understand the issues that could happen with debt, and unless you fully understand that, don't use debt. I personally don't do these strategies because for me, I don't want to go out and just take on debt to save money in taxes. If I was to use debt, I want to use it strategically to help grow the business. So just understand that the debt increases risk. Option number one is to follow the Elon method, which is now where you don't take out an income from your business, but rather you use debt to finance your lifestyle. So one of the things that Elon made really popular was the fact that he doesn't earn an income, a salary income from Tesla. He gets paid in stock options. What that means is he owns a lot of Tesla stock, billions and billions of dollars worth of Tesla stock, but this isn't cash in his bank account. So now if he wanted to actually receive any cash, he had two options. He could, one, go out and sell this Tesla stock, but as soon as he sold this Tesla stock, he'd have a huge taxable income because he created Tesla. So his basis in the Tesla stock is very low. So if he sold his Tesla stock for a huge profit, which is what he'd be doing, he'd have a big taxable income. Option number two is he can refinance out of his Tesla stock. He can use debt against the value of his Tesla stock and use his debt to pay for his lifestyle, because debt isn't taxable. It's easier to understand this with bigger numbers, so let me just explain what this means. Let's assume now that you own a business making $1 million a year. If your business is making $1 million a year, it might be worth somewhere between $10 million and $20 million, 10 to 20 times multiple, depending on what industry your business is and what your business does. So your business is worth $10 to $20 million. Now the question is, how can you realize the value of this business and use this value of your business without actually selling your business? Because if you sold your business today for $10 to $20 million, you're going to have a big tax bill. But if you just took out debt against the value of your business, now this debt isn't taxable and you also still own your business. So if you go to the bank and you say, hey bank, I have a business worth $10 million. Would you be willing to loan me $1 million? Most banks, assuming you go to the right one, are going to say yes. So now you go to the bank and you take out a $1 million loan, because the bank wants to give you money because they see the value of your business. And if you don't pay a loan, well, now the bank will get a $10 to $20 million business. So most banks want this deal because if you fail, they're going to win big time. So this is why banks would be willing to loan you $1 million. Now you have $1 million in your pocket, tax free. Because now if you were to go and refinance your home, that debt that you get that isn't taxable, debt isn't taxable. So you're just pulling cash out, tax-free with debt, and now you have $1 million to spend. Now you can use this $1 million to buy a home, you can buy a car, you can buy food, and you can live your life, and you don't have to pay any money in taxes. Now you might be saying, but now how are you going to pay back this debt? Because everybody has to pay back this debt, right? Well, the question now is, what are you going to do with your business? Because if you can keep growing your business, maybe in a few years your business isn't worth 10 to 20 million, it's worth 50 to 60 million. Now what you can do is you can say, hey bank, how about you give me another $5 million now, because my business is worth 5 times more. Now you have more money, you use this more debt to pay back this debt, and you start to play this debt game where you pay back your old debt with new debt. Now if you keep doing this until you die, you win. But the risk here is what happens if your business fails? What happens if your business doesn't grow? What happens now if you run into financial struggles? You can start to see where the risk is, but this is a way now for you to use debt as a way to finance your lifestyle without having to pay any money in taxes, because you're not taking any money out from your business. You're using debt to finance whatever you're doing, using the value of your business as security. The value of your business is the collateral. And you're using that to get a loan, which is why now this loan is tax-free. You use this money to live your life, but you only have to pay taxes if you actually pull money out, if you have taxable income, and debt is not taxable income. The second way to use debt would be to buy bigger deductions. Let me give you an example. So let's assume now that you own a business and this business makes $100,000 of profit this year. this would be your taxable income, assuming that you have no other deductions. But let's assume now that you want to go out and you want to buy that G-Wagon and you want to be able to deduct this G-Wagon against your income. Well, if a G-Wagon costs, let's just say $100,000, well, that means you're going to be out all of your cash if you buy the G-Wagon with cash. Well, option number 2 is you put down $20,000 and now you finance the other $80,000. If you were to finance the other $80,000, now you only put down 20 grand, which means you still have 80 grand in your bank account, and now you have a G-Wagon, but now you also get the tax write-off for the entire G-Wagon. Now let's assume that you use 80% of the G-Wagon for your business and you use 20% of the G-Wagon for your personal life, meaning sometimes you take this G-Wagon and you go to the movies, you hang out with your friends, you do other things. So the G-Wagon is primarily business use and some of it is for your personal life. Now what you get is an 80% deduction on the value of the G-Wagon against your taxable income. 80% of the $100,000 G-Wagon is an $80,000 deduction against your taxable income. So now you get an $80,000 deduction against your $100,000 income, meaning you only have $20,000 worth of taxable income, but you have $80,000 in your bank account. Remember, you didn't buy this G-Wagon with the $100,000 in your bank account. You bought this with a loan. You used debt. So you put down $20,000, which is why you have 80 grand in your bank account. You use the other $80,000 from the bank's money to buy the G-Wagon, but you still get to deduct 80% of the value of the G-Wagon, or $80,000, against your income. But this is where things really get fun, because now what happens if you buy something for your business but you don't have enough income to support the value of your deduction? If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.